Today, we're talking about some scary news out there. Redfin put out a really meaty article about investor home purchases declining slightly nationwide, dropping significantly in parts of Florida. We're going to dive into the data. We're going to add a little sprinkle of perspective, and we're going to ask old genius Gonzalez over here what he thinks. Hey, welcome, everybody, to the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC, because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because he goes by the name of Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be.
Good to be back in the studio with you, my friend. I'm a little raspy today.
Not going to stop you.
You might have
You're
to
a
carry the
PCP.
show. I'm gonna need your energy to do this. All right, GC. Speaking of doing it every week,
Yes.
you've been coming up with some good stats lately.
You think so?
Yeah. I challenge you with this article. Let's just throw it up here. Redfin put up this article right here. Investor home purchases decline slightly nationwide, drop significantly in parts of Florida. You know me, I don't like to read, but I like to read these like little subtitles here. Investor activities declining nationwide due to slow home buying demand, a lackluster rental market, economic uncertainty, and elevated interest rates. Next bullet point, investor market share is falling too. They bought 17% of homes that sold in the fourth quarter, down from 19% a year earlier, saying Florida investors in particular are pulling back the fastest, with purchases down 28% year over year in Orlando and down 21% in Miami. And finally, investor purchases of condos fell 13% over year to their third lowest levels of any fourth quarter since 2012. GC, when you first got at this headline, when you encountered this article, what do you think, man? What is your overall takeaway here?
Well, let me just take it from the perspective of an average investor, somebody who's just reading headlines, who might not be a real estate expert. You read that article and you're downright scared. You're like, who on earth would ever think to invest right now? You're hearing that investor market share, which, by the way, have you even heard of investor market share prior to reading this article?
Investor market share. No, it doesn't ring a bell.
No, not in real estate. But anyways, it sounds really scary and it's going way down. And then, oh my gosh, if you mention Florida as a place, oh goodness, they're just rushing.
People love to throw shade on Florida, man.
If you're an investor in Florida, you are not in this community where you're able to kind of cut through the noise a little bit, you're probably scared. But for me, this is certainly not our first rodeo. From time to time, these headlines are there, and we take some time to really dive into them. So that's what I did. Once you challenged me, you said, hey, I just saw this article. What do you think? I spent a number of hours going through it, finding my own data that either would support or maybe refute some of these things, and put some really good stuff together that I think will help inform our community, as well as kind of help shape what I believe to be the right narrative. I think this is an example, as we get into some of this article and into some parts of this article, it's another example of data without perspective. It's a common theme we talk about on this show, where there's a whole lot of data out there, but if you haven't sat in the seat of somebody who has been managing millions or even billions of dollars in single family rental properties, you don't have the perspective, and it leads you to an incorrect conclusion. And the harm in all of this is that incorrect conclusions are drawn by everyday investors. And this asset class is something that can help everyday investors so much if we can just cut through the noise, put the narratives to the side. I feel like, we have an opportunity to do some real good. So today, the focus of the show is going to be supplying real data and perspective, so that you guys might be able to draw a different conclusion than the fear mongering, which I think the headline brought.
It brings up a couple of things for me, right? It brings up the data minus perspective thing. The other thing that I think that you've talked a lot about is the amount of times that you can Google real estate crash over the last like 5 years, and all the headlines and all the things and all the exaggeration around it. We've talked often about the business model of online journalism these days being a click-driven thing. We know people run away from pain faster than they move towards pleasure. So, we see it often, this idea that a headline is made to make you scared so that you can click. And then once you read through it, it just doesn't really support the alarmist nature of it. The other thing I think about is like, I don't know why people just love to crap on Florida, man.
Yeah.
I get it so much now that I'm traveling so much. I feel like when I talk to someone about Florida, I don't know if our California friends feel this too, right? Because I feel like when you're in California, you love California, you leave California, people are like, oh my God, your life is in ruins. Right. And I feel the same way about Florida. When I leave Florida, people are like, oh my God, Florida.
Yeah.
And it feels like this has both punches. So it's probably a super popular article, which is why we like to dive headfirst into it.
Let's do it.
Yeah. So that you see the first sub headline, this idea of investor activity declining nationwide. I know that there's a chart here that you really, really wanted to like harp on this
Yeah.
year-over-year growth of investor purchases. I'm going to turn up your microphone while you're doing this.
Oh, all right, sweet. After I read this article, guys, I feel like it fed into so many just common narratives that are out there. And what I wanted to do, I thought this article was especially, I don't know, it was kind of helpful in a sense because within this own the article itself, it actually refuted a lot of its own conclusions. So here, what I'm going to do is just point on some of the things that made me say, that doesn't really make sense to me. And what we'll do towards the end of our time here today is to show some data that has been substantiated that I think shows a different mentality. But the first thing that jumped out to me is this idea of investor purchases either growing or declining.
Mhm.
That was the headline. It said investor purchases nationwide had declined slightly and dropped significantly in parts of Florida. So if that's the headline, we should really have some concrete data that doesn't have any holes in it. Well, the first thing that I saw was this graph. So this is the headline. This is the graph that's driving the headline. It says that investor activity nationwide has dropped 4%.
Mhm.
Well, if you look at this graph right here, that little blip right there that's the 4% that they're talking about.
Yeah.
So I hadn't even dug into the data yet, but I look at the graph and I'm like, I see a whole lot of dips in other years that are like multiples of 4%, but why are we writing an article, even if the data is correct, why are we writing an article about a 4% dip in investor purchase? Like, is that noteworthy?
Doesn't feel super like visually doesn't feel very noteworthy. Again, I think of the psychology and it's like you want to say something national before you say something more local so you get more attention.
Right.
But yeah, feels like a
So that seemed weird to me. I'm not saying that's right or wrong or the data is inaccurate. We'll get into some other parts of this, but that's the first graph. And I'm like, that doesn't if there's nothing else there, that doesn't really seem like something that should be the key headline. As I dug in more, I saw the source of the data. I saw that it's getting data from 39 metros. The data that we use pulls from 135 metros. So I saw a lot of other things that I think are making me question the accuracy of this.
When you pull from the 39 top metros versus the how many?
135.
135. Do you think this skews towards big city data versus like does it skew like to I would assume that like, the top 39 might be much bigger or whatever, but like at the end of the day isn't super representative of the nation if what we're trying to do is pull a national headline here.
Yeah, it's hard for me because I don't have the actual data set. So I don't want to draw conclusions that I don't see the actual data. I saw the actual data for the data I'm going to share with you. So, but at a source level, they're using the top 39 most populated metros. So you would think that it's the biggest cities. Biggest cities generally are higher priced cities as well. So it would skew, and there's less investor activity, generally speaking, in those higher priced cities.
That's what I figured.
So I think that's a good assumption, but I don't know the data that they're pulling it from. I have a lot of questions as to where the data set is.
Fair to say that the bigger the city, the less the cash flow year one, therefore the less investor activity in a big city?
Especially at times where home price affordability is a major challenge and interest rates are elevated. So I think that's fair.
So self-selecting into that, right?
I think so. I don't think that they did that on purpose. They probably use the same data set every single time. But again, it's like, what conclusion are you drawing, right? If you understand how investors make decisions and interest rates are higher and home prices are higher in your most populated cities, but investor purchases only went down 4% according to that data, is that really a headline?
I don't know.
It seems, tepid at best
Reachy.
for me. Yeah, it seems reachy at best.
All right, well, let's go into the bigger ones, right? When they're decided to like dump on Florida, saying Florida investors are pulling back the fastest with purchases down 28% year over year in Orlando and down 21% in Miami. To me, when I read that, again, when you read the stuff that confirms your own bias, you're like, yeah,
Yeah.
right. Like I've been biased on this idea that like Miami is not a great place to invest. It's why I left. I've been hot on the idea that Orlando is too much like tied to the hospitality industry for me to want to invest there. Does that have more truth?
No, it doesn't. Specifically meaning like our investor purchases down
Yeah.
in Orlando and Tampa and Miami. The data that we pay a lot of money for every single year just didn't show that. So again, I don't know the source of the data here, but I actually looked up investor purchases both on a investor market share percentage, which investor market share would be the percentage of investor purchases compared to the overall number of home purchases in a market, and the number of purchases overall. And I just didn't see anything compelling. I mean, it might have been a little up, a little down for those other markets. And then to kind of get to your point, the great thing that Tampa, Orlando, and Miami have is that they're in the state of Florida, and that the state of Florida is growing. And these are some of the fastest growing populations in the country. So, my heart is in Jacksonville, and I believe Jacksonville is the best out of those markets to invest in because I believe it's the best market in the country to invest in. However, those other markets, you could do a lot worse, in my opinion. If you're buying and holding and building a real estate portfolio for, a full market cycle, you could do a lot worse because at the end of the day, the number one contributor to your growth and to your overall profitability is home price appreciation. True. And population's been growing in the state of Florida and in those markets, and of course in Jacksonville as well for decades.
People are pouring in.
It continues to pour in. So listen, there's no perfect market out there. So some of those things that you're pointing out as far as the deficiencies of those markets are real, in my opinion. But we need to look comprehensively at how that decision would be made. So I wouldn't be the first one to just throw out an investment in Tampa, Orlando, or Miami. I think you could do a lot worse. At the same time, there's a reason why Jacksonville's a shining star.
Got it. What about this metric you see? What about this like investor market share being down but only slightly? What do you think of that?
So, as I'm reading this article, I'm going back over the times that we've done this show, and I'm thinking about all the times that I've spoke on stage and the thousands of investors that I've been able to talk to, and even being an investor myself for 20 years now. And I don't ever believe I ever looked at investor market shares being something that I really paid much attention to. Yeah. So as I was reading this article, that's just what stuck out to me. And there's a reason for that. It's because of all the things that we need to use, all the data metrics, decision-making criteria, like investor market share being down slightly or up slightly. It's just not it's not a priority. It's not something we've ever taught on the show. I don't even know the last time that I said that in terms of talking about real estate. So it's just not that important, right? So investor market share going from 19% to 17% does not help me make a decision as to whether or not I should be investing or I should be investing in a certain market. It's just like, sure, interesting data to understand. But again, if it's just an article to share that would be one thing. But this article is clearly leading towards those narratives, which is it's a bad time to invest in real estate. Yeah. Investors are running away from investing in real estate, and it's a really bad thing to be investing in the state of Florida. And those narratives just haven't proven to be true. On the show, we've talked about it for about 5 years now, how those narratives continue to happen. Yep. We did a show, I think it was the Q3 update last year, where I actually went through Google and I picked out articles every single year, going back to 2016, where they were talking about these narratives of it being a bad time to invest in real estate, and none of them proved to be true. Yeah. And on the contrary, this has proven to be an incredible asset class to invest in ever since. So I think that two things: investor market share doesn't matter to me. If it's up 2 points or down 2 points, it doesn't communicate anything to me. And then the harmful thing is that it's being used to lead to a narrative, which is an incorrect conclusion. True.
What about, I can't help but notice that they draw this line right at Q1 2020 when it seems to be a precipitous drop in investor market share. And what we see after that is like a sharp rise in investor market share. It makes me think of something you said in the Q1 market update, right? Like the idea that there's a lot of pent up demand on the sideline. You painted this like very clear picture of what seems like a powder keg, and the idea that the market generally moves a little bit slow.
Yeah.
Behind the indicators, right? So like, is there any kind of like validation to the idea that maybe this investor market share thing actually signifies a good time to buy?
You know, yes and no. I mean, I really don't think investor market share. I don't believe the masses really understand how to take advantage of a market. So investor market share to me may or may not be relevant as to whether or not it's the right time for you to make a decision to buy. It also is dependent on how many homes are being purchased outside of investors as well. That's where percentages can lead to incorrect conclusions. So I think your points are really valid. This graph may support that, but I don't really believe it really matters what the graph says. You know, investor market share is just not something in our list of criteria. I think about that fact that investor market share has gone down differently. You know, like interest rates have risen the fastest since 42 years ago, right? Interest rates rose the most. And then what we showed in the last quarterly market update is that not only did they rise the most in the last 42 years and the fastest, but when it happened 42 years ago, they quickly fell again. In Jacksonville, in our entire country and in Jacksonville, what's happened since that rise is they've gone up still. They have continued to stay up. So if I'm thinking about investor market share, and I know investors make decisions, a lot of them make decisions based on interest rates, I would have thought that investor market share would have dropped on a percentage basis more than 2%. I mean, I think the article really should say, listen, amid high interest rates, investor market share only dipped 2% nationwide. This shows that people still really love this asset class. I would have thought it would have dropped more. That's really what I would have thought.
Yeah, that's another common theme. This idea that like the biggest haymaker you can put into the real estate market is high interest rates. And like normally when you get hit with a haymaker, you get knocked out. And what we continue to see is like very, very small dips, you know, like and things continue to go upwards.
Yeah. Well, it's interesting. So in this article as well, in the little subsection, they say, you know what, investor market share is down, or the number of purchases is down 4%, but the total value of real estate purchased is up. Let me see if I've got my notes here. It's up like $36 billion year over year.
Okay.
And they go on to say that's equal to the increase in the percentage prices of homes over the last year. So like what they're basically saying there is home prices have appreciated substantially. There's $36 billion more worth of real estate that was purchased for the folks who owned properties before. Their equity has increased. So it's been a really good investment for them. And they're also saying that roughly the amount of purchases is the same as what it was a year ago. So completely like unproving the thesis of the headline buried there in the article. So that's why I said it was a helpful article, because it helped to unprove their own thesis by just reading it a little bit more.
A couple of other statistics that you teased out here. 6 in 10 local agents reporting it's not an ideal time to sell in February 2019.
Yes.
Tell me more about this local agents not selling.
So if you guys read the article, and have we put the article out there? Okay.
Fantastic. I can put it up there. I'm not sure where the local agents.
No. That's totally cool. When they have a chance to go through and read the article, I want you to read it, and because I want you to have the perspective of understanding what's really happening and understanding the narratives that are trying to be pushed here. So they said,
we got it in the article here.
Oh, there we go. Investors are retreating from Florida metros because the outlook for earning money and yada yada yada. It's poor. It says local agents in Florida reporting it's not an ideal time to sell. So then I was like, well, let me see what the data shows. And the data that would best indicate is it an easy time to sell your home, or is it a harder time to sell your home, would be the number of days on market that it takes to sell your home. So I went back and looked in 2019. Would we all agree that 2019 was a quote unquote good real estate market where people were, we wish we all could have gone back to 2019.
I would say that everybody here who bought something in 2019 was pretty happy that they bought something in 2019.
Would we have thought it was generally a good time to buy and to sell real estate in 2019, right?
Yeah.
Well, in 2019, the days on market was 57 in Jacksonville. And in February 2025, that's the last data we have available right now, literally just a month ago, the days on market is 47.
Okay.
So a lot less.
Yeah, a lot less.
So this idea that 6 in 10 local real estate agents in the state of Florida say that this is a terrible time to sell is not substantiated when you actually look at the data. The data actually shows something quite different. And I'll share with you that the median home sales price in 2019, February 2019, was $230,000. The median home sales price in February 2025 is $350,000. So the people who were buying Florida real estate, buying Jacksonville real estate in 2019 made a really good decision. Just like the people who are buying Jacksonville real estate today are making a really good decision, contrary to the headlines.
For me, this little line of 6 in 10 local agents were not an ideal time to sell and harping on that, I kind of like, I think of two things. One is I know that there are real estate agents out there that are best in class and they are incredible partners in a purchasing decision. I also know that the average real estate agent sells 1 to 3 properties a year, and they're like part-time people. So when you're talking about like 6 in 10 of them, I don't know how many of those are actually experts.
Right.
Like there's plenty of real estate agents that don't know what they're talking about when it comes to market, and what they care about is like, do you have quartz countertops or whatever, or whatever they like to harp on. But enough about real estate agents. I'm not trying to like dump on them. I just question the validity of a real estate agent. The median real estate agent, the data shows they're not experts in their market.
Yeah, I think that there's a real value for real estate agents, and I think, but it's like anything else. There are really good ones, and there are ones that are quite poor. And it's just what I know to be true is very few know the data behind the market. And I think especially finding an investor focused, because this article was talking about investors. So if they were talking about investor focused real estate agents, there's very few that actually invest themselves, very few that know the market data. So hard to take opinions from those who haven't lived in those shoes and don't know the data. And I have seen that a lot. Now, that's not to say all real estate agents are that,
Not what I'm saying. I'm not saying that.
I think that especially if it's a retail home purchase, really critical, but you don't necessarily need to know the data like we know it here.
And then the more obvious thing to me is like when a real estate agent is telling me it's not a good time to sell, as an investor, I'm thinking, oh, must be a good time to buy.
Yeah, that's interesting.
So thanks for that. Like, that's another piece of data that just like, lands on me as like, all right, this is counterintuitive to what you're saying.
Yeah, I don't think that's what they were going for in the article, but I love that you had that impression because that's the right impression.
That's really the right impression. Yeah.
It's a different impression than what most people would have outside of our community, but it is a great time to buy.
Yeah, and then beyond that, GC, is this little thing. I just find it very curious. It's saying investors in Seattle bought 33.8% more homes than a year earlier in the fourth quarter, a bigger increase than any other metro. Next comes San Jose, California, Oakland, California, San Francisco, and Detroit. The investor market share rose most in Seattle and in those areas. What do you think of that, GC?
Do we really think that buying and holding single family rental properties in Seattle, San Jose, Oakland, San Francisco, and some of the highest priced markets in the country where your rents will never get close to cash flow positive? Do we really think that the narrative that would be a better place to invest than markets like Jacksonville and in Florida is really a thing? Like, that's the narrative that an uninformed average investor would be being fed by reading this article. And it's a little infuriating because that does a lot of damage. People make decisions that, affect their livelihood. They affect their ability to produce a financial outcome for themselves, for their kids, for their future generations. And unfortunately, we just see these narratives being positioned over and over and over again. But you know what? That's why we have the opportunity to spend a little time dissecting, helping people see the other side. What else would we do with our time if we didn't have these narratives?
I don't know. Like I said, you've gotten a lot better at finding data and dissecting it. GC, I don't know if it's like GCPT or what's going on, man. But I know that you put together some data from John Burns data that you really, really trust. Let's go through some of that.
Yeah. So then, I just thought I'd share every bit of one of these data points. I just wanted to go ahead and take a look at the data that we spend a lot of money for, that we share with you openly, that has been substantiated for decades, that goes back decades and decades and decades. Many times it goes back over 40 years. So I can share with you. So if I was to even spend a whole lot of time thinking about investor market share and investor activity, this is the data that we've had, and it's a little bit different than what that article said.
And again, this is coming from John Burns Real Estate, right?
Mm-hmm.
Like you guys pay a hefty sum to do this. John Burns is a very reputable research and analyst agency, right?
Mm-hmm. Yeah,
okay,
absolutely.
So talk to me about
this. Is the same place we get all of our information based on home price appreciation rates, rent price appreciation rates, the permits and the builds that we were talking about, especially on the quarterly market update. So all
past star of the show, John Burns.
Past star of the show.
We might also like to say, yeah.
So here's what the Burns data says. So across the U.S., investor activity percentage, which is another way of saying investor market share of all home purchases, has actually increased. So the percentage of market share went up to 26% in the fourth quarter of 2024, which was a year-over-year increase. Different. Now, I will point out, it's not exactly comparing the same thing. On one hand, it is market share to market share is the same. But the Redfin article talked about how the number of purchases went down. Burns did not have the actual number of investor purchases available to me. So I didn't actually get that. But it doesn't really matter, right? The investor percentage of purchases that they talked about in the other article in Redfin said it was going down. I have data to show that it's going up. It's going up by a small amount, though, or it's going down by a small amount. Who really cares? Let's not write a headline about it. Is the main point here?
Correct. Seems like shoddy data to like base your headline on. Here's another piece of data that you found that I find really, really interesting.
Yeah. So then I said, well, you break down investor purchases into types of investors, and so the Burns data broke it down into investors who flip homes, and what they found is that flipped home transactions actually rose year over year, increased to 40,000 in the fourth quarter of 2024, which was up slightly from the fourth quarter of 2023.
When I hear flipped homes, I think, when I hear long-term buy and hold rental property investing like what we do, I think that I am bullish on the long term of the market. When I hear flipped home, I'm bullish on the short term of the market. Is that how to think about it?
Yes.
Okay, so investors, if we were to extrapolate this, and flipped home transactions have increased year over year, 40K in Q4, it means that short-term investors are more optimistic about the short-term perspective of the real estate market than they were last year.
Yeah, I mean, yes. What we're showing is that they are making their bets. They made more bets to flip a home in the fourth quarter of 2024 than they did in the fourth quarter of 2023. And why do you make a bet to flip a home?
Because you think you're going to win.
You think you're going to win,
yeah,
right?
Yeah.
It's interesting because interest rates, they're a little bit lower today than what they were back in the day, but they certainly haven't fallen dramatically. We're all still saying, oh, I wish they would go down. I wish they would go down. In the fourth quarter, there was a lot of things that, created hesitancy in the mind of an investor, right? Yeah. We had an incoming presidency. There were a lot of executive orders that were happening. Sure. We have these world wars that are stressing all of us out. I mean, there's a lot there, but short run investors in real estate actually made more bets in 2024.
Yeah, that's interesting, man. Then you found another piece of data that is about kind of like, maybe this explains it, right? Like foreign investor purchasers are down 81% since 2017.
Yeah, I thought that was really interesting and not something I had thought a lot about, but as I started to pull the data here, it made a ton of sense. So I thought I would share it with you. But yes, if you're really trying to like break down which purchases have gone way down and is a headline worthy, in my opinion, it would be this one. If you go back to 2017, we had a lot more foreign investor purchases than we do now. Foreign investor purchases represent only 1.3% of sales now.
This, to me, would be a data point that reinforces the skewing of the data for the big metros. As someone that came from Miami, tons of foreign investment, right? Like I know that the foreign investor mindset is I want to invest in something I'm familiar with, and they hear about Miami, LA, New York, Philadelphia, whatever, right? Like those cities have been in movies, right? So the idea that if foreign investment is down, then the top metros would be down, but not necessarily representative of like the top 100 metros, I think is a way to explain some of that data.
Well, so the Redfin data did not talk about foreign purchases. This is the Burns data, which is actually all 135 metros.
But the Redfin data didn't segment foreign purchases. It just said investor activity.
Gotcha. So you're saying that well, yeah. Okay.
It could skew the data. That's all I'm saying.
It certainly could skew the data. I'm just not sure if it actually went down or up.
Yeah.
So I think at a baseline, I'd first like to figure out where they got their data.
Yeah, but here's an explanation of why the data went down, why those numbers may have been affected, right?
Yeah, so this made the most sense when you think about how foreign purchases are down. It's because most major currencies have weakened compared to the US dollar. This happens when the Fed raises the Fed funds rate, it makes the dollar stronger, and it makes, in relation, the other currencies weaker. And it's interesting to think through this, but if you look at Brazil, Mexico, Russia, Canada, Japan, I mean, those are some of the biggest
Yep.
And when that happens, the goods that we sell now are just a lot more expensive to those buyers. So for example, we sell a lot of homes to Canadians, and now they're 8% more expensive to Canadian buyers, along with purchasing other goods from US.
Makes a lot of sense. Tara Paget has a question here in the Q&A. Thanks for putting that in there, Tara. She says, higher interest rates combined with higher purchase prices makes it extremely tough for the home to cover all its monthly/annual expenses on its own. The home isn't able to support itself. It ends up being the owner needing to contribute cash out of pocket to keep the property afloat. How do you respond to the reality for investors you speak to? You can't get to the appreciation in the long run if you can't afford to keep the property in the short run. LOL.
Tara, great point. So thankful you put that in the Q&A. I think that is a question that is on the minds of a lot of, I would say, newer investors. And the answer is, this is like the easiest asset class to create positive cash flow. It really is. Right? Hard to create positive cash flow in other asset classes. You think about where you may have your money in other places, hard for you to create positive cash flow. In single family rental properties, even though interest rates are higher than we want, even though insurance costs have elevated over the previous years, they've not sort of stabilized, but they've been higher, even though property taxes have been higher. Creating positive cash flow is easy. Why is it easy, Pablo? Do you know?
Because your biggest cost is your mortgage. And if you fix the mortgage in and you understand your data of like what your inputs on and you've created a standardized experience with that, then you can lock that in, would be my guess.
It's a good one. I put you on the spot there. That wasn't a gimme. And yes, all that is true. But if we really, really, really want positive cash flow, the reason it's so easy in single family rental properties is because you are in control of the amount that you put down. You have thousands of dollars of rental income coming in every single month in Jacksonville. You just decide how much of your mortgage payment you want it to be every single month. So if you want it to be break-even cash flow, which really works well for a lot of clients, you put less down and we build it so it's positive cash flow or break-even, right? Just a little bit. That's generally kind of the way we'll build a portfolio. It's break-even cash flow. You know what all those expenses are going to be because you work with a team who has done this literally thousands of times. And so that's easy. And if you're concerned, you're saying, well, what about the what if? What if something else happens? We sit down with you. We build out a plan for you, Tara. And then we say, you know what? Break-even cash flow isn't right for you. We need to have more cash flow, which means that we put more down for the purchase. And when you put more down, it lowers your monthly payment for your principal and your interest. And you've instantly created more positive cash flow. So this asset class is built for positive cash flow. It is so easy to create positive cash flow. You just need to work with a team who understands what your goals are, what your fears are, what your resources are. And we can put a plan together to make sure that you're buying the assets with the appropriate amount of cash flow for you. So Tara, I would highly encourage you to do that. Reach out to our team. You can give us a text. You can text us 904-293-0341. That's it. 904-293-0341. Or you can just shoot us an email, info@jwbcompanies.com, and we can have that discussion with you and put it on paper for you.
You know, I was ready to answer that because I was thinking through my own answer based on the fact that you have deployed me around the country to just kind of like teach how to like think about this thing. Where my head went was, you understand you understand the real fixed costs. And then the reason why most people struggle with this is that they're working with people that don't understand the variable costs. The idea that you as JWB have done two very, very interesting things. One is you've collected 20 years of proprietary data across 6,000 properties that all feel the same. And you're able to like really understand the proprietary performance of how your team is able to make it go is one thing that I would really, really be looking for when I do that kind of like down payment versus not down payment equation. And then the other piece is that all comes from the vertical integration of you delivering the home yourself and having a standard that you bring homes to, whether it's a new construction or an existing remodel. You all bring the standard level of construction up to, having no deferred maintenance in the major components, the roof, the HVAC, the plumbing, having durable, easy to maintain surfaces, and having easy to replace non-durable surfaces so that you really, really control that ecosystem would be the questions that I would be asking if I was concerned about that.
I think that is critical. It goes into working with somebody who has done this literally thousands of times. And, we just have to break this idea that like hundreds of dollars of cash flow a month on a single family rental property is success, because it's actually the opposite. Many times, if you invest in a market and you're getting more cash flow, you're giving up growth. And growth is the biggest contributor to your wealth. It is the thing that is going to help you accomplish financial goals so much more than cash flow. So that's why I keep saying cash flow is simple. It's easy. It's easy to build it out to where it's cash flow break even. It's easy to talk about how we know it's going to be cash flow break even, like you talked about. And then, what we always advocate is building a rainy day fund, because it's not perfect. There are going to be slight ups and downs, but then you build a reserve. You make sure that the money is sitting there if and when you need it, so that it doesn't impact your personal expenditures. And that's the secret. And that's what our clients have been doing for almost 20 years now. And when we get to share client success stories and you see these hundreds of thousands and millions of dollars that they've earned, it's because that's the model that they buy into.
Got it. Okay. So one of the things that we've been talking about a lot right now is national market. We know there is no national real estate market. It's all about a local market and local knowledge, right? So you, as the kind of speaker box of like the master of the local real estate knowledge here in Jacksonville, what can you tell us about investor activity and all this stuff going on in Jacksonville?
Yeah, so I pulled the data for Jacksonville, and what I found is that investor purchases were roughly the same in 2024. The percentage of total purchases was actually higher in Jacksonville in 2024. So that's that market share that they were talking about. But I think it's really interesting when I dug into the data that I'm going to share with you in just a second to see who is buying, what type of investor is buying the majority of properties.
Here's the data, buddy.
Well, here we go. So this graph on the charts on the left, on the top there, it's talking about the number of investor purchases. And so you can see there that I go back to 2023 to 2024, and you see those little bars, they're kind of up and down with a little bit of a seasonality thing. So it's largely the same. If you go year over year, it's hard to get more of the same than you can by looking at that chart. And then the chart right below it there is talking about this market share that we haven't talked too much about. But yeah, you can see it's slightly going up over the last 2 years. So the amount of purchases that investors are making is roughly the same over the last year, and the percentage is actually going up. A different reality than what you might have concluded if you were an everyday investor reading the Redfin article and thinking that that was all of Florida.
Correct. Another one that you kind of pointed out to me here is this idea that the majority of the investors are these like 1 to 9 property investors, which is us, right?
Yeah.
Which is us on the Not Your Average Investor Show community. What does this chart say about this?
I'm so glad we have an opportunity to dive a little bit more into this chart, because I think we can bring some data and perspective to a couple of things that have been brought up on the show over the years. And one of the things that has been brought up on the show is that these large institutional investors are invading single family rental properties and own 30% of the market or more. And there's a lot of fear of and angst that is brought with that narrative. So I wanted to share this with you. First off, let's look at the top there. It's looking at the amount of investors that own over 1,000 properties and what is their proportion of ownership of the entire population in the country of single family rental properties. And at the top there, you can see that these institutional investors that own over 1,000 rental properties, guys, they're only 3% of all single family rental properties that are owned nationwide. So it is not 30% or even higher, as has been reported. It's 3%. So we need to kind of keep this in perspective. I think this is important because I'm not saying these institutional investors are all great, but I'm also saying that they're not the big bad wolf that we need to be concerned about on a daily basis as far as changing our own investment strategy. It's just a good data point at this point. Contrary to that, on an individual market, talking about, actually ancillary to that.
Yeah.
For those investors that own over 1,000 properties, the thought has been, well, what happens like in a market like Jacksonville if these institutional investors own such a high percentage? What could happen if somebody who's sitting behind a desk owns 20,000 single family rental properties and just decides I'm out, and then they just throw 20,000 single family rental properties on the market and the market crashes overnight?
Yeah.
You remember, especially this was something that was brought up 2 years ago.
Yeah.
As
2020, late 2021, stuff like that, early 2022.
2-3 years ago, for sure. That was the narrative.
Yeah.
Well, I wanted to share this with you because in Jacksonville, large investors do own a proportionally higher share of single family rental properties. It's 21% in Jacksonville. But I'm here to tell you guys that this narrative, and this is what I said 2 years ago and 3 years ago, I said, guys, these large scale investors see the value of the Jacksonville market. They want to put their money in the Jacksonville market for a reason. And they are here to buy and hold because at the end of the day, they feel like this asset class is better than where they could put their money elsewhere. And they've set up all of their operations to be here for the long haul. So I didn't see a big risk that there was going to be a huge sell-off or that it was going to lead to a crash. Obviously, we've forecast that home values were going to continue to go up, and they have. So there has been no large sell-off, even though this has been 2 or 3 years of ownership. And I think it's important to note that there would have been a lot of reasons to potentially do that. Yeah. Think of interest rates being a lot higher for longer than any of us really expected. The complications of an incoming presidency, the complications of the geopolitical strife that we have with the wars that are affecting all of us, supply chain challenges, talk of recession now. Plenty of reasons around. There was a white collar recession and all these other things that came down the pipe. Been through a lot.
Yeah, we've been through a lot. At the end of the day, these folks are here to buy and hold. I would even say that I bet you most of these, I have nowhere to stand on this, but I'm assuming that these institutional investors are disciplined investors. I would assume that they have locked in really good rates, and they're not going to want to move off of those rates. So it's gonna provide a stabilizing force of these folks aren't going to have to move, right? They have this rate that's locked in, that's almost a cash flow generation all into itself by having these low rates. They're going to be here for the long haul, and that's going to provide a high floor for the market.
It is going to provide a high floor for the market. And that's one of the benefits of having a large institutional base. The chances of there ever being another 2008 crash when you have high institutional presence in a market is a lot lower of that ever happening going forward. So there's pros and there's cons. And I'm not saying one is all right and all wrong, but what I'm saying is that fear mongering of saying high institutional presence in a market leading to a large sell-off and a large crash hasn't materialized. I don't see it materializing. And what I think it does is it reinforces the topics and the concepts that we talk about on the show, that we all believe in this community, that this asset class is great. And buying and holding in a growth market makes a ton of sense. That's what the big boys and girls who are controlling hundreds of thousands of homes are deciding. And look at where they're putting their money. It's in Jacksonville. And that's where we as a community are putting our money too. So I feel great about it.
Yeah, makes sense, man. And it makes sense what they're seeing, right? When we look at these economic indicators that we've talked about a couple of weeks in a row now, the idea that the 5-year population growth rate is the 3rd highest in Florida, 5th highest in the U.S., coming in at 12%. The median household income being 2nd highest in Florida and 39th in the U.S., coming in at $82,700. The cost of living being 0.8% below the U.S., the lowest in Florida, the 27th lowest in the U.S. Unemployment rate at 3%, 2nd lowest in Florida, 12th lowest in the U.S., which leads to this this idea of low price, high wages, really, really good purchasing power for Jacksonville in comparison to the rest of Florida, to me is something that I have absolutely lived. I'm glad that we're starting to like represent this with these charts. And unsurprisingly, it's got unbelievably good home purchasing power in US growth markets in general, not just Florida, but in the United States is at number 3.
There you go.
So real quick, let's get into the end of this Q&A, but at the end of the day, portfolio investing, if you're new to the show and you're thinking about what we're talking about here, we're talking about buying and holding single family workforce housing rental properties in Jacksonville, Florida. This market that we're talking about, it's usually a minimum investment of about $50K. You're going to get an estimated internal rate of return of 9 to 10% and pretty good interest rates based on your purchasing power here and your relationships. Recently closing at 5.3% with a bunch of incentive packages happening right now. You want to explain the incentive packages?
Yes,
you see?
up to $12,000 of incentives for those who are purchasing this month. Every purchase gets between a $4,000 to $6,000 JWB maintenance cash flow credit. Basically, your first statement comes and you get a check for $4,000 to $6,000. This is a property management credit that we give on every purchase that you make. For those who are repurposing some capital, maybe taking some capital from other places and want to purchase multiples at a time, or maybe a 1031 exchange would be a great example of this. Or if you just want, this is the strategy for you and you want to purchase 3 or more, you get an additional incentive. So for those who purchase 3 or more properties at one time, you get an additional $4,000 to $6,000. This goes towards your closing cost per property. So up to 12 grand.
The Maven has a little bit of feedback.
Yeah.
It's not March anymore. It's April 1st.
Ha! I did this for our, that's funny.
Yeah, I know. Anyway, so that's happening in April right now.
I put the slides together in March and then I didn't even think about it. So
Tara says she wants to connect. Tara, pretty easy. You can text JWB 904-293-0341 and they'll get it started. You can call them 904-677-6777 or go to chatwithjwb.com. Pick out a time that works for you because she wants to see how to make those numbers work. All right, let's get into some of the Q&A. Denny Davis, the mystery man, says, Pablo, I noticed we stopped the roll call on the podcasts. How will I know which old episodes I attended? I am sure you guys made the decision to get the podcast more quickly into the meat of the show for our guest listeners. If so, probably the right call. I just love the roll calls. Denny, you are correct. We love the roll calls. We've made it a little bit shorter to just make it more listenable on the podcast. And because the roll call is for us. The roll call is for when you show up. It is part of the magic of being here live and having a nickname and all this good stuff. So you are mostly right, but it's also to add a little bit more exclusivity to showing up to the live show, which we know is not a small effort and we really appreciate. All right, Maven, Leslie Wilson says, have you heard about properties not appraising for their purchase price right now in Jacksonville? What does JWB do in this situation when an investor is under contract?
Great question. It doesn't happen very often. It happens every once in a while just because appraisers are human. But at the end of the day, all of the properties that we sell to our clients have been substantiated by other properties that have sold recently within those same neighborhoods. So it doesn't happen very often, but if it does, here's what happens. First of all, and the Maven knows this, she owns a number of properties with us. So I appreciate you giving me the opportunity to kind of share this with others. But if you're a new client, we're prepared for this situation. Before you go under contract, we explain, hey, listen, not very often, but it may not appraise. Here's how we go about this. We're going to have the opportunity for a second appraisal. When you go forward with a second appraisal, you do have to restart the loan. So there is a little bit of extra work for both us and the client. You actually have to restart the loan to get a new appraisal. It's a delay. Nobody likes it, but that's all you have to do is to go through it a second time. And then sometimes it might be like $1,000 off. And at that point, generally clients will kind of weigh the hassle of going forward with submitting more loan documents versus just paying an additional $1,000 towards their principal of the value. Because again, you're not losing out on $1,000. The purchase price is going to stay the same regardless. So it's an additional $1,000 contributed to principal. And many times clients will decide to do that. So it's up to your discretion. But either way, you're protected. And, if you have any questions, again, reach out to the team. Happy to walk any prospective client through that.
Anonymous attendee asks, how can one invest when it's so hard to get a loan? Is it hard to get a loan?
Well, I would first need to know about anonymous attendees, situation. It can be difficult to get a loan.
Yeah.
It can be more difficult to get a loan, if you're self-employed or if you're foreign, investor or things
Yeah.
of that nature. Anonymous attendee is probably from France. So
Anonymous attendee.
Anonymous attendee.
Um,
So
I heard you talking with Leslie last week about DSCR loans and loans that can close directly on the property. So it feels like things have
yeah.
gotten easier.
Well, so I think it's all relatively speaking, because
Yeah.
today is a whole lot easier to get a loan
Yeah.
versus when I started to invest
Yep.
in 2006. There are loan packages that are available. If regular conventional financing is tough for you, or if it's just a hassle, I think Leslie was talking about how it's just a huge hassle for her.
Mhm.
So you have multiple different types of loans. Happy to walk you through all of those options. And like, for example, back in the day, I think if you had 4 loans on your credit at one point, you couldn't get a conventional loan, and it stopped a lot of investors from getting their 5th property. Now for Fannie Mae, it's 10 loans, but we have lenders that can do well beyond 10 loans. Those are available. So really, lending isn't the thing that should be stopping you at this point. I would encourage you to get on the phone with our team, talk about it. We can get you that answer and find the best loan for you.
Patriarch of the first family of the Not Your Average Investor show, Ken Meline, says, do you have any data on the percentage of people who are invested mainly for cash flow as opposed to those who are invested for future retirement plans?
I don't have any data there, but I also don't know why that.
Yeah,
I
what
get
you can
why-
infer from that data.
Yeah, I don't know what I could infer from that. I was trying to think if they're mutually exclusive. Like, to me, there's some people that want more cash flow right now that are also investing for future retirement plans. I'm assuming what Ken is talking about is that are just for maximizing cash flow today. Maybe they're a little bit older and a little bit more past their working years.
Yep.
So, and that would be interesting to see if it's just max cash flow, basically all cash purchases versus ones that have either all financing or a portion of financing.
That would be interesting.
We could probably get that data, and we could probably share that on the show. So yeah, I'll go and I'll research that. So the percentage of cash purchases is what we're talking about, I think, right?
Yeah, I guess percentage of cash purchases. It sounds like percentage of people. Maybe you can look through the whys of like cash flow today versus cash flow tomorrow. I don't know. Be an interesting exercise for you who has developed his muscle in getting weird data, my friend. So great challenge, Ken. I appreciate it. Let's raise the bar on old GC. All right, last question. Anonymous attendee from La France says, can you please explain 1031 exchanges?
Yes, absolutely. A 1031 exchange is a way to basically repurpose properties that might not be performing like you want them to perform in a different part of the country, or even in the same part of the country, but it might not be the right purchases for you, and bring them over and purchase like-kind properties. So let's just say that you had a portfolio of rental properties in California, and you had a ton of equity out there, but you didn't have much cash flow. Well, you could take those properties, repurpose them, basically sell them over there, buy more properties in Jacksonville, and not pay any of the capital gains at the time of sale. So what this does is it gives you all of the money that you would have been paying taxes-wise on those capital gains, and you can use that to purchase more assets in Jacksonville. This is a great strategy for those who might not be happy for their properties in one market or another. And ultimately, at the end of the day, it allows you to build a portfolio faster. And the cool thing is you can do as many 1031 exchanges as you want. There never has to be a limit. You can continue to do that. And great way to save on taxes. So love the question.
I'm going to give it a more simpler explanation. Let's say that you bought a home in LA for $300,000. I don't know, call it 6-7 years ago. Today, it's probably worth $600,000. If you were to just sell that home and do something with that money, you would pay a large amount of tax on that extra $300,000. A 1031 exchange is a way for you to sell that home and take that $300,000, not pay any taxes on it, and invest it in other properties. So if you were to like have appreciated $300,000 in a previous real estate deal, you sold that in Jacksonville right now, you could take that and that could be the down payment for 3 other properties if you finance them, or you can just buy one straight cash and not pay the taxes on that. And that way your money continues to grow over time. There's a bunch of like things that you need to do. For example, you have to identify what the next properties that you're going to buy and be able to close within a certain amount of time. So you don't want to do this with a rookie team, but luckily JWB does this all the time. They have this assembly line of homes that are ready for people. They help you identify it. We've had guests on the show like Jag that have, like suffered through a 1031 exchange with another company, but realized that you could do it with JWB. So essentially, it's a way to like double down on the profits that you've made from purchases in another side of the country and bring it to a more affordable like market in Jacksonville with a provider like JWB that helps you do it. How about that, GC?
What he said.
What he said, Gail Bergstrom says, our 1031 exchange is only available on investment properties versus selling and buying a primary residence.
Yes. Investment properties only.
All right. GC, we did it, man.
Awesome, buddy.
A little bit over an hour. We had close to 90 people here today, middle of the work week on a Tuesday. We never take it for granted. Great questions. We appreciate you showing up for this discussion, especially our community. The fact that you add so much value in the chat and do all that really, really means the world to us. Next week, we're going to have an investor panel about, are we afraid of a recession? Like, what does this mean for investors, right? You're going to talk to current JWB clients about how, including myself, about, how we see a recession coming, how it affects our investment plans, and what are the moves that we plan to make. I think is going to be awesome. And the best news is going to come right after a Florida Gators national championship.
That's what I'm talking about.
Let's go, baby.
Go
Let's
Gators.
Let's go. GC, anything from here till then, anything people should maybe think about when it comes to their retirement and
Just
their life?
be like the Florida Gators and
Don't be average. See you next week.
See ya.